So do you think rate cuts are just delayed, not so much derailed at this point? Do you think this is a Fed that can still cut in the second half of this year?
I mean, the market is pricing in only a moderate possibility of that happening. Although I would point out we've gone from 7 cuts at the beginning of the year to less than 1 at the end. So the pendulum is swinging, I think, in quite a volatile way. Once the disinflationary trend begins to reassert, and I do think that's going to be apparent, even in the jobs market, in the weeks and months ahead, I think maybe interest rate cuts can get repriced.
Well, what's the prescription then? 60-40. On the 40 part, is it more duration? On equities, do I build more exposure to equity markets at this point? S&P's are back at 5,000, for example. Asia's done very well.
From an allocation perspective, actually, we're tilting closer to 50-50 right now. We're biased towards fixed income. We have an overweight there. We suspect that once interest rates do start to cut, then we will see a rotation from cash into bonds, in particular a mid-duration, David, to your point, in the IG space. That's where we think the sweet spot will be found, and that's where I think the highest likelihood of capital gains is likely to come from. But at the same time, earnings are looking quite resilient, quite constructive on the equity side. So that 50-50 allocation, I think, makes some sense.
Is that still mostly in the U.S. then? Is there any other equity market that you see in this universe that could actually beat what we're seeing in the U.S.?
I mean, we're obviously buyers on dips of countries like Japan and India. These are major markets. Maybe China, not so convicted. But yes, it's overwhelmingly a U.S. story for now.
Why not China?
I think China's a tactical play, David, right here. I think it's a trading opportunity coming from, I think, a very light positioning, particularly amongst foreign investors. And we're seeing some flows into that, particularly as they rotate out of tech. I think that will benefit China over the near term. But my sense is that consumption as a swing factor, which for me in China it is, still remains quite depressed. Broadly, I look at retail sales, I look at home sales, I look at consumer sentiment broadly, and I don't see any green shoots in that critically important space. And until I do, I think I'm looking at the equity market as something as a short-term trading opportunity rather than a medium or long-term investment case.
So the U.S., I'm just wondering, though, then, if that's still the better, I guess, house in the street. Is the earnings picture going to be able to sustain this rally in some ways and maybe overshadow what we've been hearing from the Fed?
Well, we're getting Q1 numbers now, aren't we? And again, they're not remarkable, but they're not unremarkable. We've seen EPS growth of around 6-7%. We're looking at earnings growth for the whole year at around 10%. And in my mind, that is looking reasonably constructive. I mean, perhaps not as good as last year, but next year, 2025, that earnings growth could tick a little higher to 13%. So I think you can make a case that earnings is likely to sustain performance, and ideally, breadth of the market starts to widen as well.